Well, markets started the week with the bank gaining over 1% and supported by positive global cues. At close, the Sensex was up 765 points. That's over 1% at 56,889, and the Nifty was up over 200 points at 16,931. A broad-based rally today. Several stocks across sectors participating. Top of the line, we saw Bharti Airtel, Divi's Labs, Axis Bank, Tata Steel and Coal India, some of the big gainers today. And on the downside, Tech Mahindra, Eicher Motors, Nestle, Infi and TCS. In fact, barring IT, all sectoral indices ended in the green. Udayan, markets just don't cease to surprise us, constantly hitting new highs. The momentum just doesn't seem to be stalling.
Hi, Aabha. It's been an amazing market, really. I mean, for the last 15 months, we've not even taken in a 10% correction despite such heady gains month on month. I've rarely seen a market which runs non-stop like this, so it's been a spectacular run. I mean, the best that is happening periodically is some rotation between sectors, which we saw last month as well, where a lot of mid caps and small caps corrected, but the large caps continue to keep the momentum higher. And that's another classic sign of a very strong bull run, where the market per se does not correct, but individual sectors and individual market cap clusters actually go in for periodic corrections. And that's the best we have seen over the last 15 months or so. So why is the correction not happening? I think one of the reasons could be that any of the triggers have not manifested themselves in a full-fledged way. I mean, just to give you an example, a few months back, there was all this talk about an inflation scare and US yields started going up. But before it could become a full-fledged scare, it sort of cooled down again, and this whole yield scare was not the trigger for a major correction. And following that, we've had other mini scares happening. Will we get a third COVID wave? Now, so far, the third COVID wave in India has thankfully not materialized, and that's not been the trigger for a correction. Sometimes market participants feel that the correction will come from the US Fed because it will say that it is starting to taper down its purchases and will raise interest rates soon. But as we saw over the weekend, that too is not happening. So my sense is that a lot of the potential triggers are floating around, but they're not manifesting themselves in a significant enough way to trigger a very big correction in the market. And one overwhelming reason could be that everybody is talking about a correction every week. Too many people are expecting it. And when it happens, as you've seen in the past, corrections usually don't materialize. There are just too many people who are unhappy with this rally, sitting out on the sidelines, praying for this correction, and the correction's just not obliging them. Haven't we seen this so many times in strong bull markets in the past?
All right. Well, India's economy is likely to have grown at a record rate in the first 3 months from April to June in the current fiscal year. A rebound despite the deadly second wave of the coronavirus from April onwards, which forced states across India to reimpose localized lockdowns and put curbs on travel. Here's what to expect when GDP data for the first quarter of fiscal 2021-22 is released on Tuesday.
A weak base and a rebound in consumer spending may mean that India's gross domestic product may have grown at a record high in the April to June period this year. According to a Reuters poll of 41 economists earlier this month, India's gross domestic product growth rate is estimated to have risen as much as 20% in the 3-month period, compared with a record contraction of 24.4% in the same quarter last year. Apart from the base effect to the abnormal contraction last year, the rebound in growth came about largely on account of a resilient industrial sector, steady uptick in exports, and improved government capital expenditure levels. Forecasts in the Reuters poll ranged from 10.5% to 31.6%, showing the considerable uncertainty around those base effects. In effect, the data will confirm that unlike the nationwide lockdown last year, repeat state-level lockdowns have had a less pronounced impact on the economy. Commenting on the GDP expectations, Rahul Bajoria, Chief India economist Barclays said, and I quote, India's second COVID 19 wave acted as a stumbling block to the robust recovery that was underway. Still, the economic damage appears to be less than previously expected. On her part, Radhika Rao, economist, DBS Bank, said, and I quote, humanitarian costs of the health crisis were high, but the economic impact was less severe than the first wave and activity rebounded faster. Aditi Nair, chief economist, ICRA, said, and I quote, the recovery remains uneven. The risks to watch out for are a third wave of COVID 19, a slower than expected pace of vaccinations, and lastly, new variants that may emerge which may not be very amenable to the vaccines which exist right now. If the Reuters poll median is realized, it would be India's fastest growth since official quarterly data started being released in the mid-1990s. That's up sharply from 1.6% in the previous quarter, but a bit slower than the Reserve Bank of India's 21.4% projection for Q1 GDP growth.
Hello and welcome to this market special from Business Today. I'm your host Udayan Mukherjee. With me is my co-host Aabha Bakaya. And joining us today to talk about the stock market is Shankar Sharma of First Global. For those of you, since this is a general audience who don't know Shankar Sharma and Devina Mehra run First Global. They've been running this brokerage and wealth management firm for nearly three decades now. And over my time in the stock market, I've always found them two of the wisest people on the Lal Street. They've seen several cycles and they've stayed on top of those cycles. There is a misnomer that Shankar is called the big bear on the Lal Street. He might have been bearish from time to time, but I don't think that that name suits him because he's been an equally prolific player in the big bull markets in the Indian stock exchange as well. Shankar, it's good to see you again. It's been a long time.
Yeah, Udayan, and even happier to see you because we've all missed you, and I'm glad to see you back in the fray.
Thank you, Shankar. Pleasure to chat with you always. But as I was just introducing you, I was saying that you've seen so many cycles, up cycles and down cycles, and this one has been a strong up cycle for the last 15 or 16 months. But there are such frequent calls for correction these days. What would you say is our position in the cycle right now? Where are we since we started the journey in April last year?
Right. So, yeah, you and I have had chats over, I think, good 20 plus years, and we've seen a lot of downs and ups. Each time there is an up, it ends up surprising us with the ferocity of it. And each time there is a down, we've been equally surprised, right? The point of all markets is really, something that I like to call the lake of returns theory. And that it's a very simple way of looking at markets, at least in terms of the big cycles. And that the theory basically holds, and this is my proprietary theory, which after making a lot of mistakes in the 90s, I figured out that the markets run on different cycles. And it basically means that whenever there is a big depletion of returns in an asset class, be it an Indian asset class or emerging markets or developed equities or fixed income, REITs, commodities, it's literally like a lake in which the water levels have depleted down, and then through osmosis and through precipitation from the clouds, the lake level begins to rise, and then that lake eventually overflows, which results in a bear market. So in 2007, when I called, and I remember we've had a very good chat in January 2008. When I had, expressed my very strong views that markets would fall a lot from where they were back in January 2008, it was coming out of the lake of returns theory that we'd had a preceding 4-year period of like 40 or 50% CAGR, which was way beyond the holding capacity of the Indian equities lake, which is more like a 15% CAGR over the long term. So when the lake levels had risen so much, it was due for a severe flooding over, and that's what led me to predict a very, very sharp downfall. This is exactly the opposite that we have seen from the March lows of last year, where the lake levels from 2008 January had really been depleted. We had seen no worthwhile returns coming up until March of 2020. It was 21,000 Sensex back in January 2008, and you will recall that. It was 28,000 in March 2020. That's a measly return of, I think, couple of percent per annum over a 12-year period. Markets were due for a massive filling up of the lake, and which is exactly what we are experiencing right now. I think this market is a lot longer and lot higher to go before we reach overflow levels. So we can keep waiting for a correction. It might even happen, but I really do not think you're into a bear market kind of, or you should be in a bear market kind of fear. At all, because the lake has got headroom left, plenty of headroom left before it ends up overflowing.
I hear you, Shankar, but all bull markets, I mean, they usually last 3, 4, 5 years, but they take in fairly meaningful corrections, sometimes 10%, sometimes as much as 20%. This market's just been one way, and I agree that it's been only 15 months, but it's just been a one-way street. At some point, are we going to get one of those nasty bull market corrections? And if you had to call it, how soon is it that we are likely to see one?
In a lot of senses, Udayan, that might have already happened, although it has been on the stealth. It's not been visible. But the small caps, small relative mid caps, borderline have corrected, fairly decently. I mean, it's been a pretty ugly 20, 25 days. Many have fallen 30 odd percent, even though the headline indices may not reflect that. I'm not saying this is the correction you and I are worried about, but there has been somewhat of a correction. But remember one more thing, that we have never lived in an era wherein we have had these kind of interest rates. So therefore, maybe all the normal rules of markets uh, may not apply, that markets run up 100%, then they correct like 10, 20%, then again they run up 50%. Simply because the price of growth, the discount rate at which we will price growth has fallen to levels we have never seen in the history of financial markets. When that happens, really all bets of valuations, all bets of what is rational really evaporates. And I think you're in pretty much that period. It may not seem logical, but if you just look at it from the lens of ultra low rates, then almost every single thing starts to look attractive. I mean, that's really the underpinnings of this bull market, that when you crush rates down to a percent, percent and a half, then even moderate growth amplifies in present value terms. That's a simple arithmetic of a discounted cash flow. So in those situations, you can run a fair bit before any meaningful correction can happen. I've been expecting it for the last 4 or 5 months. I've been utterly wrong. So I now have kind of given up trying to predict that, to be absolutely honest with you.
It's time to raise tariffs. That's the message from Bharti Airtel founder chairman Sunil Mittal. A day after India's second largest telecom company announced plans to raise up to 21,000 crore rupees via sale of shares to existing shareholders. Mittal told analysts that the company will not shy away from raising prices. Bharti Airtel is boosting its balance sheet as it seeks to cut debt and build a war chest to prepare for the launch of 5G services. Mittal added that 5G will become a reality in the second half of next year and that Bharti Airtel is betting big on customer appetite for fifth-generation mobile technology that delivers super-fast mobile broadband data speeds. Take a listen in to what Sunil Mittal had to say earlier today.
You can't go beyond a point where you start to hurt yourself. We will be vigilant, but we will be happy to take small baby steps, which could even be first and foremost compared to others. So I can assure you that we will not shy away from doing it. And the 79 rupees and some postpaid plans which have been taken up are a testimony that we have run out of patience and we have taken the first move.
Udayan, let's take a closer look at some of that commentary coming out of Jackson Hole, over the weekend. We touched upon this with Shankar as well in our conversation with him. But what really do you feel one can deduce from the Fed's commentary now going forward? How long will they really hold off from those much dreaded rate hikes?
They are not going to rock the boat, Aabha, and that's the clear message which is coming out from the US Fed, that they will not scare the markets. They've done it in the past, experimented with doing something, and then they've got jolted by the market's reaction. And this time they're moving at a very, very slow and steady pace, and they're signaling their intent well in advance so that markets don't get roiled. So baby steps. And over the weekend at Jackson Hole, it was pretty much the same. The Fed went to great lengths to assure the market that there is no interest rate hike on the cards anytime in the foreseeable future. The best it will do, or the worst it will do, is sometime during the course of the year, it could be October, it could be December, they will start tapering some of the purchases, which means they will purchase fewer bonds. That will admittedly soak up some of the liquidity with which emerging markets, including other asset classes, have been sloshing around. But it's not enough to trigger a massive reaction in the market or the correction that we've all been talking about. So I think the Fed this time is saying we need to step back, but the process of withdrawal will be so slow and so well advertised in advance that stock markets will have no reason to fall off the cliff. And that's part of the reason why we saw such a handsome rally in global assets, including the Indian market today. The markets heaved a sigh of relief after Jackson Hole.
Well, from markets to some corporate news now. Maruti Suzuki has announced that the company will increase the prices of all its models effective September 2021. Maruti has not mentioned the percentage of the hike and claims that the rise in input costs is the reason. This is the third price hike by Maruti Suzuki this year. Let's go across to Aishwarya Paliwal, who's been tracking this story. Aishwarya, what are the details of the price hike? Will other companies also follow suit?
For all those people who are looking at buying a new vehicle this upcoming festive season, this season will bring you no cheer. There are not many discounts available, and with Maruti Suzuki, who's a leader in the automotive sector in our country, has said that they'll be increasing prices. Now we can expect the others also to follow suit. Now when we do a comparison with the kind of discounts which were given in August last year and the kind of discounts we saw across the board this year, it's almost half. Which means, if say for example a Maruti was giving you a discount of 60,000, this year it's only giving you a discount of 30,000. More than that, car manufacturers say there is a huge gap between the demand and the supply. The production has reduced because of the shortage of semiconductors, and the steel cost is through the roof, because of which we are now seeing an increase in various variants in the cars. Now usually we used to see the festive season used to be a time when there used to be massive discounts on almost all the variants, and all the automotive companies used to give it. But this year the companies are saying, because they themselves have to pump in a lot of money to make sure that the production keeps on running, they are also saying the production cost has gone up over the past 3 to 4 months. This festive season will definitely bring no cheer for all those people who are looking at getting their own vehicles, getting the color they wanted, and getting a car on a particular date. All these things will not happen this festive season.
The sixth tranche of the Sovereign Gold Bond Scheme 2021-22 is now open for subscription for 5 days. The issue price has been fixed at 4,732 rupees per gram of gold. A discount of 50 rupees per gram is provided by the government to those investors applying and paying online. For such investors, the issue price will be 4,682 rupees per gram. The tenor of the bond is for a period of 8 years, with an exit option after the 5th year to be exercised on the next interest payment dates. India's largest lender, State Bank of India, tweeted what it calls the 6 golden reasons to invest in sovereign gold bonds. The scheme was launched by the government in November 2015 under the Gold Monetization Scheme. And here's a look at some cryptocurrency price action today. As per CoinDCX data, as of 5 p.m. IST, Bitcoin traded at below the psychological resistance price of $50,000, showing ongoing sign of recovery from a disorderly route just 3 months ago. On its part, Ethereum is holding on to its strong momentum against Bitcoin after the EIP 1559 upgrade, resulting in the daily burning of Ethereum supply. Other top cryptos are showing neutral price action.